learning module within level 1 derivatives. We're going to cover this learning module in 4 videos. The first one will cover an introduction and forwards and futures. Second video will cover swaps. Third will cover options. And the fourth one will cover credit derivatives and a comparison of forward commitments and contingent claims. Now, let's start with the introduction. So as we discussed in the videos for the previous learning module, which is the first learning module of level 1 derivatives, we're going to get in more details about the difference in firm commitments and contingent claims. So there are two types of derivatives. One is firm commitment, the other one is a contingent claim. Before I get into the difference of these two, let me just re-emphasize on the word derivative and where it's coming from. So since a derivative is a financial instrument, which is actually a legal contract, which derives its value from the performance of an underlying asset, and hence it is known as a derivative because it derives its value from an underlying asset. Now there are two types of firm commitments. There are two types of derivatives. One is a firm commitment and the other one is contingent claim. Now we've briefly talked about this in the video for the previous learning module, which is the first learning module of derivatives. And in firm commitments, both parties, which is the long party and the short party, that is the buyer and the seller. So both parties have obligations, right, to abide by the contract. Whereas in contingent claim, the long party or the one that is buying this claim has an option or a right but no obligation. So this is the basic difference between these two, that a firm commitment is basically just that. It is a firm commitment that you are committed, you are firmly committed, you cannot change your mind. You have an obligation, whether it is a forward or a future or a swap. Now forward and futures, they are very, very similar in nature. The only difference is that forwards are over the counter and futures are exchange traded derivatives. And we talked about this in a previous video, that what is the difference between over the counter and exchange traded, and we will re-emphasize during this video as well. So let's move on and do this, just that. So a firm commitment is a firm commitment. You cannot get out of this transaction. Once it is agreed upon, then you have to abide by the terms of this contract, which usually means that some point in the future, you're going to have to, the long party is going to have to buy this asset and the short party is going to have to sell or deliver that asset in the future when the contract expires. The identity of the asset, that what it is that they are buying and selling, and the amount of, whether if it's a number of shares or number of bonds or whatever the underlying asset is established in the contract, and it is exchanged when the expiration of the contract is there. Let me emphasize again that both parties, the buyer and the seller, have an obligation. There is no option here. This is a firm commitment. Now, these two types of firm commitments, which are forwards and futures, are very, very similar in nature. The only difference is these are over the counter and these are exchange traded, and we will talk more about that. And swaps are also similar, but there are some differences in swaps. So in this first video on this learning module, we'll be talking about forward and futures only. There will be a second video after this in which we will discuss swaps. But before we move on to forward and futures, I want to talk a little bit about the other type of derivatives, which are contingent claims. Now, contingent claims are not an obligation for both parties, but for one of the parties, it is a right, but not the obligation. So remember the example from the video on the first learning module where we had a company called Amy Investments, and Amy Investments was getting into a forward contract to sell, what was it, 1,000 shares of Airbus, right? And I believe the price was euro 30. So if the share price in the market falls down to 25 euros, Amy will be happy, right? Because they got into a contract to sell for 30 euros. That's good. They'll be happy because the market is at 25 and they're being able to sell at 30. But what if the market price of these shares at the expiry of the contract was 35? Amy wouldn't be happy because they could possibly sell in the market at 35, but they won't be able to because they got into a contract to sell at 30. But if instead of a forward contract, what they had bought was a put option, which is an example of a contingent claim. So options are most common type of contingent claims. And if they had bought a put option instead of a forward contract, right? Instead of a forward contract, then they would have the right, not the obligation, to sell. So they would have a right, not obligation, to sell 1,000 shares of Airbus. Now, if the market drops to 25, then they would exercise their right of selling at 30. But if it goes up to 35, then they would not exercise their right to sell at 30 and they would rather sell at 35 in the market. So this is the difference between firm commitments and contingent claims, that a contingent claim gives the holder of the contingent claim the right but not the obligation to make a final payment contingent on the performance of an underlying. Now, this is the holder of the contingent claim, which means if you're buying a put option, it gives you the right to sell. And if you buy a call option, then it will give you the right to, call option gives you the right to purchase or buy. But we will get into a lot more detail about options in a separate video altogether. So in this video, we will be getting into more details of firm commitments, and specifically two types of firm commitments. Number one, forwards, and the second one is futures. So first, forwards. And forwards and futures, by the way, are very similar. The difference is that forwards are over the counter and futures are exchange traded. Now, if you remember from a previous video, whenever we talk about over-the-counter derivatives, the advantage of this is that they are customized, right? They are private between two parties. Think of two banks. And I have given this example before, that let's say there is Bank of America and Bank of Mexico, and this is the counter, this is the person at the counter, this is the counter of Bank of America, this is the person at the counter of Bank of America, and they get into a deal directly, right? So they can get into a customized deal. It's private, it's not standardized, it's not through an exchange, right? They agree on a price at which the asset will be bought or sold at a later date in the future, right? The price is fixed and there is going to be a delivery of the asset at the time of the expiry of the contract. The identity of the asset has to be clearly written in the contract. How many units of that asset will be delivered, right? Whether it is gold, so then the price will be fixed per gram, the number of grams. If it's stocks, then price per stock, number of stocks. And this will be a completely customized contract where the two parties are getting into a deal themselves, and this is not traded over the exchange. One very important point over here is that there is possibly counterparty risk, which means if, for example, Bank of Mexico doesn't want to pay, then Bank of America can face risk of the counterparty defaulting. So here is the risk of a forward contract, that the long hopes that the underlying will increase in value. So let's say the Bank of America is the long party, and they are buying gold and they are hoping gold will go up, while the short party, which is Bank of Mexico, is hoping that the gold value will go down. Now, one of the two will happen, obviously. Either gold will go up, right, or gold will go down. No money is exchanged at the start of the contract, right? And the value of the contract is 0 at initiation. So let's say this is the price of gold. And let's say at the start of the contract, the price of gold is $1,300. So we're starting from this point. And if, let's say, the price of gold goes up, then Bank of America will be going into profits. But if the price of gold goes down, then Bank of America will have a loss. And who will have a profit if it goes down? The Bank of Mexico will have a profit. And if the price goes up, so Bank of America is going to have a profit, but Bank of Mexico is going to have a loss. So think about it this way, that it's a zero-sum game, right? Depending on the price, if it goes up, one will gain, the other will lose, and if it goes down, one will win and the other will lose. So now let's look at this diagram, which is a more formalized version, and let's look at the payoff for both. So the long party is Bank of America and the short party is Bank of Mexico. Now this is the price at which the initiation value is 0 for both, right? As the price of gold goes up, the payoff for the long goes up and the payoff for the short goes down. And vice versa, if the price goes down, the payoff for the short goes up. It is more profitable for the short party, whereas it will be a loss for the long party. So long party is profitable when the price is going up, and short party is profitable when the price is going down. The long party benefits if the spot price increases, and the short party benefits when the spot price falls. Let's look at an example of a forward contract. So there is a company called Viz. They want to sell 500 shares of a beverage maker FTC to Fizz at $50 per share after 180 days. What happens if the market price of FTC at expiry is 50, 60, 70 or 80? So let's have a look at this. Fizz is the long party, right? And Viz is the short party, because as we can see over here, Viz wants to sell, hence they are the short party. And who is buying? Fizz is buying, so they are long because they are buying, right? So Fizz is the long party and Viz is the short party. Now we're going to look at things from Fizz's perspective, that is the long party. And naturally, if the price goes up from 50 to 60, then Fizz will benefit. If it goes to 70, Fizz will benefit even more. But if it goes to 40, Viz will benefit, right? So if it goes to 40, then Viz will benefit. If it goes to 60 or 70, then the long party, which is Fizz, is going to benefit. And you can see that from this chart over here, that at 50, which is the price at which the contract is being signed, it is 0, right, for both parties. And right now we're looking at the perspective of the long party only. And if it goes up from there, their profit is going up. So if it goes, let's say, from 50 to 60, their profit goes from 0 to 10. As you can see that this is from 0 to 10 when it is increasing from 50 to 60. It goes up another 10 from 60 to 70. Their profitability goes from 10 to 20, as you can see over here, right? And at expiry, if it is 40, let's say if it falls, then at 40, the long party will lose 10, whereas the opposite situation will be happening for the short party. So from the short party's perspective, which is Viz, it is exactly the opposite. If the share price rises, they will lose, and if it falls, they will win. Now, this is exactly like forwards. The only difference is this is not over the counter. This is exchange traded derivatives, right? So therefore, they are not customized. They are standardized. This is a standard product sold on the exchange. And an example of such an exchange is the Chicago Mercantile Exchange. There are many others in the world. In a futures contract, the two parties agree, like a forward, to exchange a specific quantity of an underlying asset at an agreed upon price at a later date. So this is exactly like a forward. The only difference is that this is standardized, right? Whereas a forward is customized. And the difference over here is that there is an exchange in the middle, right? So the exchange actually takes care of the risk of the counterparty defaulting. And this is basically a future. There is also an agreed upon price over here called the future price, and one party, which is the long party, agrees to purchase the asset, and the other party, which is the short party or the seller, agrees to sell the asset. Now, futures versus forwards, there are similarities, but there are some differences as well. So the similarities are both parties, there are two parties in both agreeing into getting into a contract. There is an underlying asset, there is a fixed price called the future price or the forward price, and there is an expiry date, right? These are all similar characteristics. However, future contracts are standardized, forward contracts are customized. These are over the counter, these are exchange traded derivatives, and they are traded on a futures exchange. Futures have a futures price denoted by a small f. Forwards have a forward price denoted by a capital F. Gains and losses. Now, this is important. Because futures are traded through an exchange on a daily basis, the gains and losses are settled through something called a process called mark to market. And I'm going to give you an example of this. And why this is done is because both parties are having an exchange in the middle, and whatever is the gain for one party and the loss for the other party is settled on a daily basis. So they don't leave anything to chance. They're not leaving anything at risk. There is no counterparty risk. The exchange in the middle is settling on a daily basis the profit and loss for both parties. And by the way, if one party runs out of a security deposit which the exchange is keeping, then they will get something called a margin call. And you might have heard this word before. So both parties actually have to deposit a margin in a futures clearing house, and their profit and loss is adjusted from that margin. And if that margin finishes because you are having too much loss, then you will get a call to post or deposit more margin. Now, the settlement price, by the way, of a futures contract is not the last price traded, but an average of the final trades. So when the market is about to close, they will take the last few trades and they will take an average of that, and that is what is called a settlement price. And the clearing house determines this. So this is determined by the clearing house. What happens when the expiration of the contract comes close? So let's say we started a contract to buy gold at $1,300 per ounce, and when we are about to expire, the price of when the contract is about to expire, the price of gold is $1,200. So this contract price was actually with each passing day, as the contract comes close to expiry, it will converge, it will come to the same price as the spot price at the time of expiration. And this is because obviously the contract is expiring and the physical has to be delivered. So it will come exactly close to the spot, and then eventually it will be a spot transaction when the delivery is made and the payment is done, right? So that brings me to the last line here, that at expiry, the futures contract, the short delivers the asset and the long pays the spot price. Let's look at an example of a futures contract. So Anne enters into a contract to buy 100 grams of gold at 55 per gram after 90 days. The futures price is 55 at which they are getting into this contract, and after 1 day the futures price is 58. Now just hold on over here and let's look at what happened. So you got into a contract at 55, right? At this point your payoff is 0, but the price goes up, right? So naturally you're going to be in a profit of 858 minus 55 is 3. So you will actually go into a profit of 3. So there is a gain of 3. And it's not just for 1 gram, this is for 100 grams. So 3 into 100 grams is $300, right? So there will be a credit to Anne's account. Now let's say Anne had initially deposited an initial margin of $1,000 in her futures account, right? The futures account will be credited by $300 and her margin will be looking like 1,300. Now on the opposite side of the contract, let's say there is somebody called Mark and they had sold this 100 grams of gold and they also deposited initial margin of 1,000, but they will lose this 300 because they have gone short. Now their margin is looking like 1,000 minus 300 is $700. This is what Mark has in his futures trading account now. And the futures exchange will have something called a maintenance margin, which could be a certain percentage of the trade size, right? So the trade size we are looking at is actually the starting price is 55, right, multiplied by the transaction size, which is 100 gram. So the size of this trade is $5,500, and maybe if you are supposed to keep a 10% margin at all times, so 10% of this will be $550. And if this amount, which is the margin left in Mark's account, if this goes below 550, then they will get what is called a margin call, that they will get a call and they will have to deposit more margin. If the balance falls below the maintenance margin, additional funds must be deposited to bring the balance up to the initial margin again, which was $1,000. And this process of mark to market manages the counterparty risk so that either party cannot default because the profit and loss is settled on a daily basis. But what if, let's say, Mark has a $1,000 deposit, right? And so Mark's deposit is $1,000, and at 55 they get into a deal of 100 grams, and let's say the price falls to $35 overnight suddenly. So how much of a difference is this? This is $20. So $20 multiplied by the 100 grams is a loss of $2,000. Now Mark's deposit is $100, that is gone, and Mark still has to pay another $1,000 to make the other party whole. But his deposit was only 1,000 and he refuses to pay more money. So in that situation, what will the exchange do? So to prevent this kind of a situation, to have such a big fall is not allowed. And how do they control this? By setting price limits, right? So that the trades cannot go beyond a certain price. Let's say that could be 45. So it cannot go below $45 and the trading will be stopped at 45. So if the price reaches one of the previous day's limit, then if the price reaches that limit, the trading stops. And this is known as a circuit breaker, to pause the intraday trading for a brief period if the limit is reached. Because sometimes, markets are acting very, very dangerously and the prices are just dropping because people are panicking. To stop that kind of a situation, what we have is circuit breakers, but this is not in all situations, right? So this is only in some futures contracts that limit the daily price changes. Usually things can go down and they can go south very fast So you have to be very, very careful. And if you want to see a real life example, look at the oil price when it went so down that it actually became negative. It became less than zero. So if you're interested, look into that, and hope to see you in the next video.